LVMH's fashion and leather goods, the group's crown jewel, posted a 1% fall in Q4 2024, after a 6% decline in Q3, ending a long growth streak. This is the same division that houses Louis Vuitton and Dior, supposedly bulletproof brands that drove the luxury boom for years. The luxury market stands at a critical juncture, with China suffering its most severe 20% downturn since 2011. These statistics don't represent a mere temporary setback, but indicate a fundamental transformation in the luxury sector landscape. The data shows a clear split between winners and losers. For years, most luxury brands rose together. One brand's success lifted others. They shared customers and rode the same trends. In 2024, that changed. Bain reported only 1/3 of brands grew, 2/3 declined. This was a structural shift, not a seasonal dip. Hermès kept double-digit growth. LVMH struggled. After peaking in early 2023, LVMH's market value fell by tens of billions of euros. The market separated into two groups: brands with strong, focused equity and broad portfolios that weakened in a downturn. LVMH's diversification turned into a burden. Fashion and leather goods slumped, and wine, spirits, perfumes, watches, and handbags were hit at the same time, especially as Chinese demand softened. The once balanced risk now multiplied it. Hermès' single brand focus and managed scarcity reduced these risks. Birkins had wait lists while other goods elsewhere sat unsold. Scale became a problem. Each LVMH division needed attention, but resources were spread thin. Large portfolios created coordination issues. Complex supply chains became fragile. Broad marketing lost clarity as consumers looked for authentic brands. The broad luxury boom of the 2010s and early 2020s, that period was fueled by new wealth, strong markets, low rates, and high savings. In 2024, the market turned selective. Only the strongest brands thrived. China was the main growth driver for luxury over the past decade. Lines formed at Louis Vuitton in Shanghai and Beijing. Chinese buyers powered global sales. LVMH invested heavily to serve this market. Flagships in top cities, local teams, and marketing on WeChat and Weibo. The plan assumed steady growth. In 2024, the market fell 20%, the sharpest drop since 2011. Growth turned negative fast. Real estate losses hit confidence. When property values dropped, discretionary spending fell with it. Many Chinese buyers didn't stop buying luxury. They shifted purchases abroad. Price gaps made shopping in Tokyo, Milan, or Paris cheaper. Example, a $3,000 Louis Vuitton bag in Shanghai could be about $2,400 in Tokyo. An $800 Hermès scarf in Beijing might be $650 in Milan. For multiple item trips, the savings were large and came with travel. LVMH still sold to Chinese customers, but more sales booked outside mainland China. Paris, Milan, and Tokyo saw higher traffic. China-based stores with high fixed costs saw revenue decline. Global pricing played a role too. Higher China prices covered duties, taxes, and currency risk, but easy travel turned those premiums into disadvantages. Regional teams started competing with the company's own stores in other countries. Shoppers checked prices online and flew to buy where it was cheaper. Influencers shared guides, and the behavior spread. And pressure was building at other markets too. Gen Z and young millennials show less interest in visible logos. They focus more on sustainability and experiences. Brands spent millions to study them, updated online strategies for social media, and changed products to fit their tastes. Many in this group now prefer subtle branding. They skip LV patterns on bags and Dior logos on clothes. They question paying high prices to promote a brand. Studies show they choose experiences over items. Trips to Japan beat designer purses, concerts, festivals, and travel create memories. A $3,000 bag stays in storage. Flashing logos now feel off. Thrift finds and vintage get praised. Brands who spot deals earn respect over those buying pricey goods. Influencers share cheap alternatives and social media spreads it. Sustainability adds pressure for LVMH. These buyers want details on sources, factory conditions, and environmental effects. Brands tied to exclusivity find transparency hard without losing appeal. Two forces shape this: preferences for realness and values over status, plus debt and housing costs that make luxury feel wrong. Social media changed buying. They seek unique pieces for personal style and follow small influencers, not brand promoters. Old marketing misses. French craft stories don't connect. Exclusivity seems snobby. Quality claims weaken when fast fashion offers similar looks for less. The old approach of exclusivity and status is losing ground with this group. LVMH faces a gap where their main offer doesn't fit future buyers. If they skip status goods, what happens to prices and margins in luxury? For years, luxury brands could raise prices and people still bought. A 5% or 8% increase felt normal. Many buyers saw higher prices as a sign of desirability. From 20 to 23, brands pushed 8 to 10% hikes each year, and demand grew. Louis Vuitton raised handbag prices several times a year. Dior lifted perfume prices. Bulgari increased jewelry prices. Buyers often hurried to purchase before the next increase. High pricing power drove strong margins and expansion. In 2024, that stopped. Interest rates jumped, markets got shaky, real estate and currency swung. Wealthy buyers began to question purchases. The focus shifted from display to preservation. People started asking, will this hold value? Instead of, do I want it? Spending moved toward items seen as stores of value. Watches, jewelry, art. Gold jewelry looked better than leather handbags. Rolex felt smarter than designer apparel. Vintage Hermès seemed safer than new seasonal pieces. Inflation squeezed the upper middle customers who traded up during the pandemic. These were professionals who bought a designer item for milestones. Rising housing, food, and transport costs cut their discretionary budgets. A $1,500 bag now competed with core expenses. Entry-level luxury slipped out of reach, shrinking the customer base. Buying became calculated. People checked resale values, compared brands, and tracked which items held value. Shopping turned strategic. The financial hit showed up fast. In H1 2025, LVMH revenue fell 4% to 39.81 billion euros, and net profit dropped 22%. This pointed to a deeper shift in how luxury will operate and exposed weakness in LVMH's model that the boom had masked. LVMH's large portfolio turned into a weakness. It owns 75 plus brands across 5 areas: fashion and leather goods, wines and spirits, perfumes and cosmetics, watches and jewelry, and retail. The variety looks like protection in downturns. Hermès offers a contrast. One brand, clear message, tight supply, faster decisions. Investors reward that focus. Forward earning near 53 times versus LVMH around 20 times. LVMH's complexity made quick pivots hard. Any pricing or product change required coordination across dozens of brands and markets, each with different customers and competitors. As markets turned volatile, size slowed decisions. Inventory and timing issues hit multiple divisions. Some boutiques closed in key cities, from New York to Shanghai, sending poor signals to shoppers and rivals. What once was a scale advantage became a disadvantage, leaving LVMH less agile than focused rivals. And then these operational issues pointed to a deeper challenge tied to what luxury buyers value. Customer loyalty was the next hit. Reports of data breaches at Louis Vuitton and Dior hurt trust when LVMH needed it most. In-store service relies on personal knowledge, name, size, preferences, purchase history. That level of service is core to luxury. Luxury buyers pay for relationships based on exclusivity, discretion, and trust. A $5,000 bag includes the promise of privacy. Data leaks break that promise. The breaches exposed names, contact details, purchase histories, preferences, and stylist notes. VIP lists surfaced. Private communications were accessible. This wasn't a small IT issue. It cut into the mystique that supports luxury. breaches violate those expectations. People realize their details sit in vulnerable systems. For high net worth clients, privacy is critical. They are targets. Timing made it worse. Economic caution, young buyers avoiding logos, and a weaker China market were already in play. A trust crisis questioned the core value of luxury retail. Rebuilding trust got harder and costlier. New customers hesitated to share data. Loyalty can't be assumed in a more transparent world. With trust shaken and sales softening, LVMH shifted focus from products to experiences. L. Catterton, backed by LVMH, led an $800 million investment in FlexJet, a move into private aviation and time as luxury. This was a major bet while core brands showed weaker sales. At first glance, it looked odd. Handbag and perfume sales were down, and fashion faced inventory issues. Aviation has different supply chains, customers, and operations than luxury retail. The signal was clear: shift toward experiential luxury, private travel, hotels, dining, where wealthy customers are spending. Rather than products to own, focus on access and experiences to use. Private jets offer time savings, privacy, flexibility, and status. A bag sits in a closet, a jet solves problems and creates experiences. Portfolio moves point to focus. Off-White was sold, Stella McCartney bought back its stake, talks continue around Marc Jacobs, and a possible Sephora spinoff. The aim is to back brands that fit the new direction. Sephora is a strong retailer, but it's closer to beauty retail than luxury experiences. Price increases in some U.S. manufacturing aim to protect margins and reduce tariff risk, but they may turn off price-sensitive buyers. The goal is to position remaining brands at the top while reducing supply chain risks. Making goods in the U.S. hedges trade disputes and can appeal to buyers who want domestic production. Digital efforts target China and in-store upgrades to regain customers. LVMH is shifting from selling products to building a lifestyle ecosystem that offers access, experiences, and services across many touchpoints. Whether this works depends on a basic question about the future of luxury.